You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to. I really want to talk about what's on your mind, so we're going to do a Q&A in a minute. There are a couple questions I always get asked. People always say, well, who should I go to work for when I get out? And I've got a very simple answer. We may elaborate more on this as we go along, but the real thing to do is to get going in for some institution or individual that you admire. I mean, it's crazy to take in between jobs just because they look good on your resume or because you get a little higher starting pay. I was up at Harvard a while back, and a very nice young guy picked me up at the airport, Harvard Business School attendee, and he said, look, I went to undergrad here, and then I worked for X and Y and Z, and now I've come here. And he said, I thought it would really round up my resume perfectly if I went to work now for a big management consulting firm. And I said, well, is that what you want to do? And he said, no, but he said, that's the perfect resume. And I said, well, when are you going to start doing what you like? And he said, well, I'll get to that someday. And I said, well, your plan sounds to me a lot like saving up sex for your old age. It just doesn't make a lot of sense. I told that same group, I said, go to work for whomever you admire the most. And I said, you can't get a bad result. You'll jump out of bed in the morning and you'll be having fun. And the dean called me up a couple of weeks later. He said, what'd you tell those kids? He said, they're all becoming self-employed. So you've got a temporary offer. And I've told you that you could pick any one of your classmates, and you now know each other probably pretty well after being here for a while. You'd have 24 hours to think it over, and you can pick any one of your classmates, and you get 10% of their earnings for the rest of their lives. And I ask you, what goes through your mind in determining which one of those you would pick? You can't pick the one with the richest father. That doesn't count. I mean, you've got to do this on merit. But you probably wouldn't pick the person that gets the highest grades in the class. I mean, there's nothing wrong with getting the highest grades in the class, but that isn't going to be the quality that sets apart a big winner from the rest of the pack. Think about who you would pick and why. And I think you'll find when you get through, you'll pick some individual. You've all got the ability. You wouldn't be here otherwise. You've all got the energy. I mean, you've got, the initiative is here, the intelligence is here throughout the class. But some of you are going to be bigger winners than others. And it gets down to a bunch of qualities that, interestingly enough, are self-made. I mean, it's not how tall you are. It's not whether you can kick a football 60 yards. It's not whether you can run the 100-yard dash in 10 seconds. It's not whether you're the best-looking person in the room. It's a whole bunch of qualities that really come out of Ben Franklin or the Boy Scout code or whatever it may be. I mean, it's integrity, it's honesty, it's generosity, it's being willing to do more than your share. It's just all those qualities that are, again, it isn't the person with the lowest grades or anything of the sort. It's the person who just doesn't shape up in the character department. I mean, we look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first two will kill you. Because if you're going to get somebody without integrity, you want them lazy and dumb. I mean, you don't want them smart and energetic. So it's that third quality, but everything about that quality is your choice. You can't change the way you are wired much, but you can change a lot of what you do with that wiring. And It's the habits that you generate now on those qualities. I mean, in the end, those are habit patterns. And the time to form the right habits is when you're your age. I mean, it doesn't do me much good to get golf lessons now. If I'd gotten golf lessons when I was your age, I might be a decent golfer. But someone once said the chains of habit are too light to be felt until they're too heavy to be broken. And I see that all the time. I see people with habit patterns that are self-destructive when they're 50 or 60, and they really can't change them. They're imprisoned by that. But you're not imprisoned by anything. So when you write down the qualities of that person that you'd like to buy 10% of, look at that list and ask yourself, is there anything on that list I couldn't do? And the answer is there won't be. And when you look at the person you sell short and you look at those qualities that you don't like, if you see any of those in yourself, egotism, whatever it may be, selfishness, you can get rid of that. I mean, that is not ordained. And if you follow that, and Ben Franklin did this, and my old boss Ben Graham did this at early ages in their young teens. Ben Graham looked around and he said, who do I admire? And he wanted to be admired himself, and he said, why do I admire these other people? And he said, if I admire them for these reasons, maybe other people will admire me if I behave in a similar manner. And he decided what kind of a person he wanted to be. And if you follow that, at the end, you'll be the person you want to buy 10% of. I mean, just stand in line and I'll be Regis Philbin, and you can.
Yes.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures in investing. I'll just play around on the computer. And defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, I'm no genius, he said, but I'm smart in spots, and I stay around those spots. And that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, the stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should. So now let's go over here.
Hello, Mr. Buffett. I got a company.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, That's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value,
Written down your set of formulas or your strategies in written form so you can share it with everyone else.
well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop. Because here Aesop was in 600 BC. Smart man. Wasn't smart enough to know it was 600 BC, though. I mean, would take a little foresight. But Aesop, in between tortoises and hares and all these other things, he found time to write about, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete. Because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. But he was halfway there in 600 BC. That's all there is to investing, is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get two birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3%, and you can get two birds out in 20 years, it still makes sense to give up the bird in the hand, because it all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But they still take the bird that you give them if in the hand. But I actually have written about this sort of thing, and stealing heavily from Aesop, who wrote it some 2,600 years ago. But what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business, because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago, or close to it, when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I know. I passed it up. And those are the big, big mistakes. And I've had plenty of them. And unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. They don't agree with the way I think. That's fine, but I don't want them to be disappointed in me. So I lay out there and I say, in terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth, See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire because that's the way I want to live my life. I've got all the money I could possibly need. It just amounts to a change in the newspaper story on my obituary and the amount of money that the foundation has. And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high, in all likelihood. I mean, they're entitled to know that. You really think for a minute, if you're going to get married, and you want a marriage that's going to last, not necessarily the happiest marriage, or one that Martha Stewart will talk about or anything, but you want a marriage that's going to last. What quality do you look for in a spouse? One quality. Do you look for brains? Do you look for humor? Do you look for character? Do you look for beauty? No. You look for low expectations. I mean, that is the marriage that's going to last. Both have low expectations. I mean, and I want my partners to be on the low side on expectations coming in because I want the marriage to last. It's a financial marriage when they join me at Berkshire, and I don't want them to think I'm going to do things that I'm publicity just because of the scale he's on, but he doesn't care about that. I can promise you that. So that's my philosophy, is that I got this money not because I'm a superior human being, not because I've done more for society than other people. I was wired the right way to be dropped into the United States at this particular time. I mean, it's a huge capitalistic society, and I'm wired, no credit to me, but I just born that way, so that I'm better at asset allocation than other people to some degree. Just like other people are better at all kinds of other things. And I was with 2 teachers out at Sun Valley that are doing more for society than I am, and this market system does nothing for them. Market system does all kinds of things for me. Gates says if I'd been born 5,000 years ago, I'd have been some animal's lunch, because I can't run very fast, can't climb trees. I mean, and I could tell that animal is chasing me, wait till you see how I can allocate assets, But it wouldn't have made any difference. So here I am, I'm born now, just very, very lucky. And the odds when I was born in 1930, the odds were 50 to 1 against me being born in the United States. That's a terrible set of odds to face. And yet I was dropped down here, And if I'd been dropped down in Peru or someplace or China, I mean, I wouldn't have had a chance. So society is what does it for you. And it should go back, in my view, it should go back to society. If you've been lucky enough to be dropped into a society where your particular wiring pays off big, that's just luck. And there's nothing wrong with being lucky. I don't feel guilty about it or anything else, but I also don't feel that, I feel I have a lot of fun doing what I do, but I feel the money should go back into society, and it should go back as intelligently as it can. And the best way to do it intelligently is to have high-grade years. I mean, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains. It takes temperament. It takes the ability. She brought 7 siblings over from Russia, one at a time, $50 every time she saved $50. She sold used clothing and other works. She got her 7 siblings over, her mother and father, and by 1937, 16 years after she got here, she saved $500. She got on a train, went to Chicago, to the American Furniture Mart, which was this huge, impressive thing. She was smart as hell, but she thought like a peasant in a way, and she saw this building and she decided to name her company the Nebraska Furniture Mart. She went in and bought $500 worth of, she bought about $2,000 worth of merchandise. All the way back to Omaha, she worried because she thought, I owe $1,500, and she only had a $500 equity. So she got to Omaha. She took the bed, the sofa, the refrigerator out of her own home to sell fast so she could get the money so she could pay on time. She took that business and built it from that start. No one would sell to her. She went into court 4 times because the carpet manufacturers tried to keep her from selling at a discount, and she went into court and told the judge, because she figured out ways to buy this stuff in various nefarious ways from had other people buy it for her, and she said, look, I pay $3 a yard for this carpet. Brandeis sells it for $6.98. She says, I sell it for $3.98. Just tell me, Judge, how much you want me to rob people. She defended herself. Papers wrote it up. The judge bought carpet from her the next day. I mean, it was marvelous. Brandeis isn't selling anymore. They were the huge department store in Omaha. She put everybody out of business. And the punchline, she worked till she was 103. She sold me the business when she was 89. And she didn't have an audit. I went out to see her one afternoon. I took a check out with me and because I knew she wanted to do something. And I said, Mrs. B, here's the money. I said, I don't need an audit. Just tell me whether you owe any money. She said, I've never owed any money since I owed those guys back in 1937. And she said, it's all free and clear. She'd never seen a balance sheet. She didn't know what accounting terms meant, but she understood the nature of the business. And I told her, I said, I'd rather have your word, than an audit from every one of the big 6 or big 8 or whatever there were, the number at the time of the top auditing firms. And she worked till she was 103. She died at 104. She had 3 siblings at her funeral. I mean, those are some genes. Her son works there now. He's 82 or 3, and the 3 sisters are all alive. But the punchline is, she couldn't read or write. This woman could not read or write. If you told her this room was 68 feet by 43, she would tell you how many square yards it was like that. She never went to school a day in her life. She would tell you how much that was at $5.98 a yard. She'd add the tax. She'd knock off something because she liked your looks, and that would be it. And that you can't beat that, you know, and you can't replicate that at General Motors. You can't institutionalize that. The person who brings that kind of drive to a business and does it day after day and thinks about their customer, and that's all she did. Well, she raised 4 kids in the process too, but you can't, it can't miss. And no, you don't have to worry